Hello, Deep Valley community. Welcome back. As always, this is our value investing journey, so please subscribe so you can get my next video installment. One of the questions that came up was what I do in terms of looking at stocks, whether it is applicable to small caps as well. I often talk just about large caps because I want to kind of get past the narrative so you know the company Facebook or Apple, so that it's quite quick in your mind to understand what I'm trying to drive at in terms of a specific key dynamic. So I'm going to show a screener. This is a screener that I used to use. I don't use this as often nowadays because nowadays I'm in a fortunate position that because of my large following on Seeking Alpha, many people write to me pretty much on a weekly basis. So my job is just to be selective and say no to as much as possible. Opportunities are going to come your way if you kind of work very hard at this, are going to come your way all the time. And you just, like Warren Buffett says, there's no strikes for batting out. I mean, I'm not into baseball or whatever, but it's just the idea that you have to be extremely selective when you put down capital. So in my mind, whenever I'm buying into a stock, I'm always thinking in my mind that, okay, this is a business that I'm buying, and I take the same responsibility when I'm investing mine and my family's capital that I'm buying a house. I think in my mind, okay, I'm buying a house. I'm going to have to be committed to this house for the approximately, let's say, 5 years. So that's the level of diligence that I try and think. Well, I don't know if you ever bought a house, but I assume that you would have. So it's that kind of thinking that you have to think, okay, I'm really responsible. There's no exit strategy, like if you buy a house and you don't get along with your neighbors, that's just how it goes. So you got to think like that. So let's get stuck in. So what I used to do, and this is kind of really jogs your head a lot. So I'd come on Finviz, and I'd kind of look here. I'd like to look for established businesses, what Warren Buffett used to do with the durables, like even when his investment in Apple today, it's a very durable business. It's a business that's just fairly predictable and just, it's consumer led, but it's no different from when he was really buying into Gillette. It's a stable business. The share price fluctuates a lot, and the narrative around the company is kind of in fashion, out of fashion. People like it, people hate it, but it's a very durable business. So it's that type of investment that I try to do. I just try to follow the trodden path what Warren Buffett did. So I come on either. This is the only two things that I would change is that I'll come on either the Nasdaq exchange or the New York Stock Exchange. I prefer the New York Stock Exchange as a starting point simply because there are more boring companies. I believe that the best way to make a return is by looking for very boring companies that make a lot of free cash flow. So I would start with just that, and I look at companies that are less than 10 billion because I want something that's kind of like not very followed. I want something that is very underfollowed. I don't want to kind of be competing with the rest of Wall Street on this. I want to think something that has few analysts following. It leaves itself to more discrepancy from intrinsic value. So it can be, there are moments where a small cap can be crazily overvalued, and there are moments where it can be severely undervalued. So I'm trying to pick out severely undervalued companies, and typically, not always, but typically less followed companies, there's more wiggle room. So I'm just trying to look for something that's less than 10 billion, and I like to start at 30% from the highs. Now at the moment, because of the massive sell-off, loads of these companies are available, so it's great this time. And I look at the US again. I don't want to kind of go into Turkey or something, nothing wrong with Turkey, but I just want to go for a boring business that has been around for many cycles. And I would look and I would start. So when I was doing this, I'm just trying to get to know as quickly as possible. So I don't want to go something that is really unpredictable. So I would say like businesses like banks, I'm not going to be touching that. Stuff like utilities, I'm not going to be touching that. Stuff like rates, like that's not what I do. And so I'm looking for a business that I kind of have in mind and start straight away. So I see straight up here that there's Gartner. Gartner is a well-known business. So this type is a service business. This is the type of thing that I'll be interested in. So I'll look here. So I see, so I'm trying to go through as many companies as possible when I'm doing this. I wouldn't be talking, obviously, I'll just kind of be plugging on. So I go on to Morningstar and I see here that Gartner's financials are very nice. I can see here the share. This is one of the things that I look up straight away, whether the dilute in the shareholder over the last 10 years or whether the number of shares is stable or ideally the number of shares are reducing over time. This tells me that as an owner of the business, just by me owning the company, my ownership is increasing over time. This is one of the things that I look at. Like, this is my preference. I don't like dividends. I don't want to do that. So I want to see that the business is able to be sustainable and hopefully throwing off free cash flow. So in this case, I can see that the business has some growth, which is great, and it has a stable share price. Awesome. So then I would look to see if anyone actually, I'll go on Dataroma just to see if any of the investors that I follow, if you do this a lot, you kind of know a lot of the investors off by name. So there's nobody really following this business. So I can see here just very quickly that the business makes about, I always just look at free cash flow as my preferred. I don't like to faff around with no income. I want to see just free cash flow, what the business is making. So the business is making, let's say, approximately 350 million. Just call it wrong like that, because obviously if I take this as a peak number, but just to say, okay, the business is making about 350. So let's say the service business, you kind of, in approximately 5 billion, it's about like 12x to free cash flow, kind of in the ballpark of that. So that will be a reasonable multiple. So I'd come on Seeking Alpha because I write here a lot. So I just look here. So the business here, I see the markup is 9 billion. So I'm not going to start faffing around with something that is trading like already into my kind of upside potential. So this is something that I would look at. But let's say, just for the sake of this example, that the market cap was approximately 6 billion, just for the sake of conversation. So the next thing I would look at, I'll come here and I just straight out going to see the balance sheet. How clean is this business? So I can see here that it has some cash, great. Has 2 billion in debt. That's a lot of debt for a business is making about 400 million in free cash flow. Now, a quick and dirty way to think about it is if the business's free cash flow covers, if the debt is covered by 10 times the free cash flow, so in this case would be if the long-term debt was higher than 4 billion, that's like straight no. I'll take 10 years for the business at its current rate to be spitting out free cash flow just to go to the creditors. That would mean you as a shareholder would not get any dividends, would not get any share buybacks. So in this case, it is large. It's 2 billion. It is not the end of the world. So if the market cap was suitable, I would kind of I'll start looking further. Just for the sake of conversation, I'll keep going through my mental thought here. So let's say, okay, the debt is slightly higher than I would like it to be, and the valuation is slightly higher. So like this is already 2 strikes, and I'm already on to the next one. But just for showing you more thinking of mine, so I'll come here and just look at the valuation, and I'll just say, okay, oh, the price of sales has come down. So in the past, people have been willing to pay approximately 3.6 times the price is trailing price of sales, and now people are willing to pay 2.3. So that's okay, it's come down by a third, it's not bad. And similarly, I'll look here and so okay, it's quite stable. So it tells me straight away that because the price of sales here is relatively stable, it shows me that the sentiment of investors towards this business hasn't really come down a lot. It tells me that people are still quite infused about the business. People are still willing to give the benefit of the doubt to the business. So this is not something that I would say, okay, that's a bargain opportunity and I'm going to pound. So the way to do about it is every time that you make an investment, you think, okay, I'm going to be stuck with this business for about 3 or 5 years. Because if anything shorter than 3 years, I think it's just really speculation. You can kind of have a good run with that, and you can, you'll have a few losses. But if you're really frank and honest yourself, and I always look at my track record, just to see that just cuts through all the BS. Just kind of if you look at your track record since your inception, and you just look at that, how is the whole portfolio doing over time? Because we as human beings, human nature, to always remember the times that we've done really well. We talk to everyone about the times that we've done really well. But what I do is the reverse. I only talk about the losses. By only talking about the losses are always at the forefront of my mind. And anyone that I talk to, any friend or investor, whatever, they always, because that's the topic of conversation, we always talk about the losses that I have. And it helps me to just really sizzle them in. Every time I make a loss, I was like, it's it's my family's money, it's someone else's money that I've kind of, so I always think about that. It's the losses, if you just avoid having losses, then the next time you make a tiny gain on the stock, it's gain. It's not like, so I don't run with stop losses. A lot of people have stop losses, but if you've read Peter Lynch's book, he says, show me a man with 20% stop loss, and I'll show you a man with 20% loss. Because the market is really volatile, and the stop losses are designed to make brokers rich. It doesn't make you as the owner of the business rich. Because sometimes the market kind of sells off crazily, and you don't want to be stopped out because two things happen there. The first problem that happens when you get stopped out of the stock, and if the share price continues going low, you feel good about yourself. You're like, oh, I did a good decision for getting out of that business. You're not thinking about the fundamentals. And if the share price then rallies back up, you say, oh, it just got away from me. It's like, I'm not going to chase it up now. But by remaining invested in the business, like a business owner, like Warren Buffett says, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. So if you really just think like that, avoiding losses, working hard, saying no to a lot of opportunities, and just being responsible, like being accountable. So I like to post always on Seeking Alpha every morning when I wake up. I like to post my track record, and I do that for myself. I want the world to see like whether I'm doing well or I'm doing badly, because I want to be honest myself. I want to be honest, how am I doing over time. So I predominantly invest in small caps. That's pretty much what I do. So at this moment in time, I'm kind of matching the S&P, and for me that's terrific because I'm just investing like really small caps, and small caps has just been utterly demolished. So if I can outperform small caps when they're just getting crushed, I believe that when at some point in time when small caps kind of recover a little bit, I'm just going to smash the S&P. So my benchmark is really the S&P 500, but by only investing in small caps, when that recovery comes, it gives me a huge chance because these stocks, like you buying really cheap stocks, let's say at approximately 3 to 4 to 5 times free cash flow, they're really out of favor. So anyway, I hope you found that video useful. It's a bit longer than normal, but please drop me some questions and subscribe. Thank you for watching. Bye bye.